So you are doing that now. You're saying to me now that the 600 billion will be 1 trillion.
Definitely, because what we are signing, it will facilitate that, and
I like that very
on
much. No, we're doing numbers that nobody's ever done. And in all fairness, if you didn't see potential in the U.S., you wouldn't be doing that.
Definitely.
You don't want to lose money.
As you said, Mr. President, it's the most hottest country in the planet.
And that's President Trump hosting the Crown Prince of Saudi Arabia at the White House yesterday, securing an increased investment from the Saudis of $1 trillion into America. This market-moving investment is covering a lot of sectors, including AI to nuclear power, even the commercial real estate market. Joining me now is the founder and CEO of Cain International, Jonathan Goldstein, back with me. Jonathan, great to see you. Thank you so much for being here. What do you make of this investment from the Saudis? It impacts real estate as well. How would you assess it?
No, I think it's clearly a significantly positive move for the U.S. economy and an endorsement of the relationship between Saudi and the U.S. and the underlying strength of the U.S. economy. And I think if you look at it from a real estate perspective, you try to look at the areas in which you'll see growth. Obviously, AI and the whole industry around that's going to continue to see significant investment. We believe in gateway cities, and we've seen the Saudi Arabians, through PIF and through other organizations, invest strongly in gateway cities. And in terms of other growth areas, we still see the hospitality sector. America's a very popular place to come to, the luxury end of that, both in terms of hotels and in terms of residential branded products attached to that. We see that as significant growth areas, and the Saudi Arabian commitment to the American economy is really going to support those and reinforce those areas.
And you've been investing and continue to. You acquired the Dominic Hotel in New York. You've got office towers throughout New York and in California. Tell us about your own investments and where you see opportunity right now, Jonathan.
Well, we just a few months ago acquired the Dominic Hotel down in Soho, and we're very excited about that. 400 keys in New York, right opposite the Disney headquarters. Extremely strong market in New York at the moment. Obviously, we want to make sure that continues, and we want to make sure that the new political environment doesn't upset that apple cart. But we're seeing strength across various areas. We've been big investors in South Florida for a number of years now. The Delano Hotel, we're bringing back to its former glory, and will be opening in spring of 2026. We have the largest office block in South Florida that's been built for a generation at 830 Brickell. Fully leased, Microsoft, Thoma Bravo, Citadel, great client list in that building. And obviously in the pictures you're showing on the screen, our flagship project in Beverly Hills. We're so excited to be bringing Aman Hotel and the residences together with the reinvigorated Beverly Hilton and a retail offering, which is going to hopefully rival Rodeo Drive, to the heart of Beverly Hills. So, what you're seeing as a theme in that is our belief in the United States, our belief in the strength of the economy, and our belief in the top end of the market as, a real growth area in the coming years.
Yeah. Well, I mean, how do you assess the top of the market, things like hotels and luxury, which of course continue to do well, versus office buildings, whereas you've got a changing worker? Some want to be hybrid, don't want to go back to the office. What's your take there?
Well, we've continually believed since the very beginning that there is a future for the office building. I don't believe, and I think many of the business leaders now are showing and saying publicly, that the working from home model doesn't work. It doesn't work for the business, and it doesn't work for the individual. Very few individuals are really going to grow and fulfill their potential, maximize their talent by sitting at home in their front room with a laptop on their laps. So, we've continually invested in top-end offices, but what you have to make sure is they're fully amenitized, and you're offering a reason for people to come to the office. If you go to 830 Brickell, you'll see an absolute floor of facilities, both in terms of catering and restaurants, in gyms. If you visit the new JP Morgan headquarters, as I'm sure you've done in New York, you'll see the most extraordinary offering that they put forward for their employees there to ensure that they want to be in the office, that the office is a place for community. And that's really what you're looking to ensure. Now, of course, there is a problem with secondary offices that don't have that level of facilities, but I think you're finding a real disparity between the top end of the market where you're offering that and those where I'm afraid, maybe are 30, 40 years old or in need of significant investment.
Yeah, it's a great point. That J.P. Morgan building is so gorgeous. They've got so many restaurants, gyms, et cetera, et cetera. One reason Jamie Dimon wants people back at their desks, no doubt about it, $3 billion building. But I want to get your take on what you just mentioned. That's the politics, the new politics, because wealthy New Yorkers are leaving New York City. As Mayor-elect Zohran Mamdani is vowing to enact socialist policies on day one of his term. Look at some of the people who he's putting in his administration. One Miami developer told Fox his company closed more than $100 million worth of signed contracts over the past few months, twice last year's volume. Jonathan, what do you think the impact will be of these socialist policies on New York real estate?
Well, I think, firstly, I don't think they'll succeed. So I think it's important to understand and look at history and understand what works and what doesn't work in cities like this. Second, I think we need to underscore New York's resilience. Right, New York's been through many cycles, but New York is New York. It's the financial capital of the world. It's an extraordinary city, extraordinary vibrancy, and I'm sure it will outlast the current political cycle. But having said that, I think the big difference between now and the past is that people are so much more mobile than they were in the past. So ability for people to up and go is significantly greater than it was in the past, and I think people need to look at that and understand the impact of their policies on that top end, those wealth creators in the city who create so many jobs for the city, and you know, people benefit from that. So of course, I think I'm preaching to the choir in understanding and having some level of reticence about what might be coming. But I think we need to look long term as well and say, you know, New York will outlast the current administration.
And we also don't know if he's actually going to be able to pull all this stuff off, right? He's got a lot of ideas like free buses, which actually are not his authority. So there's that. And we're showing this graphic of the blue state exodus, Jonathan. 1.7 million people have left New York, and they've gone to low-tax states, places like Texas. Do you follow that in your own portfolio when you see that kind of exodus?
Well, we've seen that in Florida. We've been investors in Miami since 2016. We just got entitlements for a residential development down in Palm Beach, one of the first residential developments for many, many years. So we've followed that trend for many years. We've seen that migration. We've seen that people want to live in these low-tax environments. The weather's quite nice down there as well. So, I mean, you know, there's lots of benefits, the infrastructure, the transport, the schooling. There's many, many opportunities that maybe weren't there 10, 15, 20 years ago. So I think when people sit behind their desk and start to think about policies in the new administration, they need to factor into the reality of the situation, both the ability to deliver those policies, but secondly, the impact upon real and ordinary and day-to-day New Yorkers if you end up having a migration of talent or a continued migration of talent away from New York to other low-tax states.
Jonathan, what's your take on interest rates? Fed governors are divided over a potential third rate cut at this next meeting in December. Mortgage rates up slightly from last week at around 6.2% or so. How do you see the outlook for commercial and real estate when considering interest rates, where the 10-year right now is up at 4.11%?
Yeah, well, the 10-year's been stable for some time, somewhere between 4 and 4.2 for some considerable time. And I think, obviously, as a real estate investor, we benefit from lower rates, and we would encourage a continued reduction in the headline rate. And I think if you look at the underlying economy, and I heard some of you were talking about retail reports, just this morning, and other housing stats. I think the economy can support a continued reduction in that headline rate to ensure that people are investing in the underlying economy, to make sure that creates jobs, that creates development, that creates opportunity for all.
Yeah, I was surprised that, the first-time home buyer is 40 years old. The median home buyer right now is 59.
Well, that's a reason why. I mean, the higher the rates, the more difficult it is to get on the ladder. And when you spend time talking about affordability, obviously affordability in terms of housing, both and the indirect impact on rents comes from the level of interest rates. So it's encouraging. It would be an encouragement to to those people who wish to invest, who wish to buy, to bring down that headline rate and bring them back into the marketplace and bring that headline number down from 59 back to where it should be, because people should be encouraged in their 30s and 40s to be house owners.
Exactly. Jonathan, it's great to catch up. Always a pleasure. Thanks so much for coming in.
Thank you for having me.